Your company's gonna IPO. What do you do? First of all, congratulations. That is a huge step. Woohoo! Not a lot of companies get there, and you helped build the company, so it should be celebrated. The good news is your equity is about to be worth something more than just on paper. Is there anything you should think about with your equity before the IPO? One of the problems, a good problem to have, but still a problem, is that as a company gets close to its IPO, the cost to exercise your options starts to rise, sometimes skyrocketing. So planning around exercising before you get to the IPO is key to maximizing your profits. So why might options exercise cost more at the IPO? When you exercise your options, you'll pay taxes on the difference between your strike price and the fair market value of the stock. Before an IPO, that fair market value, or 409A, is usually lower than the actual value of the shares. As a company gets closer to IPO, that fair market value usually rises to the IPO price, and after the IPO, it's whatever the shares are trading at. As long as the stock price continues to rise, you have an opportunity to save on taxes by exercising before the IPO. We have seen people miss out on hundreds of thousands, if not millions of dollars by not exercising pre-IPO. That's money that is going into the IRS's pocket instead of yours. This isn't always the case, but for top companies that are growing fast, exercising pre-IPO is a no-brainer. What are the risks to exercising pre-IPO? Exercising pre-IPO gives you shares in a private company. There's no guarantee that that company will actually go public, and then you could be stuck with an illiquid stock. There's also a risk that the shares could decrease in value after the IPO. Depending on the company where you work and the market conditions, those risks may be inconsequential. I hope that answers your questions about what to do with your stock options before your company IPOs.